which makes gold more expensive in dollar terms. This inverse correlation is one of the key principles in the financial markets, especially when it comes to commodities and currencies. But that's not always the case. There are moments in history when gold and the dollar have both risen together. This usually happens during extreme financial stress when investors lose faith in the global economy. They pile into both the dollar and gold for safety. For example, during the 2008 financial crisis, we saw both assets rise at different points because investors wanted liquidity in the form of dollars, but also protection through gold. It's a rare but notable phenomenon. In the United States, gold and the dollar serve very different purposes for different types of people. For the Federal Reserve, the dollar is a tool of monetary policy. The Fed raises or lowers interest rates to control inflation and support economic growth. When rates go up, the dollar usually strengthens, because higher interest rates attract foreign investment, but higher rates also make gold less attractive, since gold doesn't pay any interest or dividends, so holding gold becomes less appealing when bonds or savings accounts offer higher returns. However, when inflation gets out of control, like we've seen in recent years, gold becomes more appealing again. This is because gold is seen as a hedge against inflation. When the purchasing power of the dollar declines due to rising prices, gold often retains its value. People buy gold as a way to protect their wealth. That's why in high inflation periods, demand for gold tends to spike, especially in the US market where inflation data is closely watched by both retail and institutional investors. Let us also talk about how global events affect this gold-dollar dynamic. Whenever